Today, from the investment frontline. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. Today, we discuss a recent post looking at Australian finance and property from an international investment manager's perspective. Those following our work will find it surprisingly familiar. As reported in Investor Daily, following the global financial crisis, the US Federal Reserve has effectively been exporting extraordinary loose monetary policy to markets across the world. As a result, one of the unintended consequences has been a growing number of asset bubbles around the world, especially in countries where central banks have been forced to run looser monetary policy than they might have wished. James McLevy, Head of Rates Portfolio Manager at AIM's Fixed Income and Target Return Funds at Aviva Investors, has written about Australia. And by the way, if you value the content we produce, please do consider joining our Patreon program where you can support our ability to continue to make great content. Here is the link, and it's also in the comments below. He says that nowhere is the asset bubble more apparent than in Australia, where the RBA has arguably kept monetary policy looser than domestic economic conditions warranted to try to cap the Australian dollar's value. The resulting loose monetary policy has fueled an unsustainable boom in house prices, with strong demand from Chinese investors having further inflated the market. Given the magnitude of price increases, in Sydney, for example, prices have risen 80%, Australia's housing market has for some time appeared a prime candidate for a sizable correction. Until now, the prevailing wisdom has been that such a downturn was unlikely without significantly higher interest rates or rising unemployment. However, in recent months, a new threat has emerged. The government in February set up a royal commission to investigate alleged misconduct in the financial services industry. Having examined potential breaches of responsible lending laws in relation to the sale of home loans, it appears to be taking a more rigorous view of banks' lending practices, with allegations of fraudulent activity having led some politicians to clamour for more draconian action. The now Australian Prime Minister Scott Morrison warned financial sector executives responsible for breaches of corporate law that they could face jail, and banks have begun to tighten lending criteria. Notably, in screening mortgage requests, they are undertaking greater due diligence to verify applicants' income and living expenses to assess their ability to service and repay their loans. With a material tightening of the availability of credit now underway, suddenly there are plausible grounds for concern. Australia could be headed for trouble. That could have serious consequences for house prices, the country's economy, and, ironically, the banks themselves. The dangers posed to the banks are all the more acute, given mortgages account for somewhere between 60 and 65% of their assets, which is high by international comparisons. Furthermore, much of this housing collateral is sitting on banks' balance sheets at inflated valuations, adding to their vulnerability to a housing downturn. At the same time, Australian households' finances have begun to look increasingly stretched. The ratio of total household debt to income is now high by international standards. According to a recent report from the RBA, it has risen by almost 30 percentage points to close on 190% over the past 5 years, after being broadly unchanged for close to a decade. At the time of writing, 3 of the 4 major Australian banks had announced increases in their variable mortgage rates, despite benchmark lending rates having been held unchanged. With Australian wage growth remaining stagnant, this is likely to lead to Australian households further tightening their purse strings. Worryingly, many mortgages are on interest-only terms, but are set to revert to capital repayment mortgages in the coming years. According to a recent research note, UBS analysts believe Australian banks wrote around $650 billion in interest-only mortgages over the past 5 years, representing around 40% of total mortgage lending. With the Australian Prudential Regulatory Authority having placed a 30% cap on such mortgages, they estimate that around $120 billion of these mortgages will revert to capital repayment loans each year until 2021. The UBS analysts estimate repayments on these mortgages will increase by between 30 and 50%, leading to a material squeeze on incomes and forcing many into selling their homes. In 2017, APRA conducted a stress test of the country's 13 largest lenders. It found in aggregate that the Common Equity Tier 1 ratio of the industry fell from around 10.5% to a little over 7% by year 3, and under a worst-case scenario to just below 6%. APRA concluded that although banks would potentially suffer significant losses, its results nevertheless provide a degree of reassurance. Banks remained above regulatory minimum levels in very severe stress scenarios. The regulator has simultaneously been looking to strengthen banks' ability to withstand a housing downturn by changing the risk weightings on mortgages and introducing other macroprudential measures to limit riskier types of lending. For example, it is looking to tighten lending in Sydney, Melbourne and Perth by encouraging banks to stop lending to developers of high-rise properties, a segment of the market that is suffering from high vacancy rates and has been left badly exposed by the nascent downturn. Sydney ranks among the most expensive real estate markets in the world. He concludes that it remains to be seen to what extent the steps the regulators have taken will help limit the scale of losses made by banks in the event of a more severe property market downturn. The dilemma it is facing is that by tightening lending standards, it runs the risk of causing property prices to fall further, intensifying the problems faced by the banks. And some of the problems facing Australians are eerily reminiscent of the events seen in the US and Western Europe in 2008. While Australian banks may yet avoid the catastrophe that befell institutions in the US and Europe, at the very least their profits appear vulnerable and their debt at risk of downgrades, especially given their resilience on wholesale markets for funding. Given these concerns, he says, we believe the Reserve Bank of Australia will struggle to raise interest rates as fast as other central banks. For some time now, we have been short the Australian dollar and bank debt via credit default swaps and long, short-dated government bonds. Given the danger the Royal Commission will continue to generate adverse headlines for Australian banks, and given the bearish outlook for the country's property market, we have in recent months increased the size of each of these positions. And from our recent conversations with other institutional investors internationally, he is not alone. As always, if you like what you've seen here today, please share and like the post and add a comment or question. I read them all. And if you want to join the growing band of subscribers who receive alerts when we release new posts, do subscribe now by hitting the subscribe bell. And if you've already subscribed, many thanks. I really appreciate your support and participation. I'm Martin North, the Principal Analyst at Digital Finance Analytics. Many thanks for watching, and I'll talk to you again next time.